The following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour. My pleasure to be here, and of course some great shows we've had already today. I hope I can add something to it. The E-mini is down 250 at 2070.75. The Dow is down 30 at 17,699. The S&P is down 2 3/4 at 2070. This is going to be interesting. Gold is just unsure right now. It's been coming down the last few days. Dollar's making a potential peak D for a little bit of a pullback. We'll see what happens here. So gold is at 1087. Silver's at minus 11 at 14.30. Platinum's down. High-grade copper. Oh, I didn't even notice that. High-grade copper is now at 222. High-grade copper, HG. 220. Yeah, look at that full return. Oh my goodness, that is really a sharp pullback. Let me just have a quick look at gold here. Yep, gold. Yep, gold's broken that support. This is going to be very interesting. And the dollar right now is in leg D. Continued high. It was down a little bit earlier this morning. It's come back quite nicely, up 38 to 99.36. I'm going to show you a couple of things in a few minutes. I hope I can get to it without forgetting, because just a lot going on that I need to look at today with you. Yesterday, of course, I was out of town. Sorry for the last very, very final few minutes that I was waving my arms and hit the I hit the mic extension cord, and bam, I just lost it. I could hear, but you couldn't hear me. So that was a pity. So all right, the dollar is getting back to the area that I said 99, the 99.30s is right there now, to the 100.39 area. That's the resistance area. It's only a leg C in the weekly chart, but it is what I call a retracement failure mode. Doesn't mean to say it's failing, it's just explaining that underneath the previous high, it can fail at any point. So you have to be looking at the technicals and the shorter term to see if there's a follow-through pattern, and that is happening now. The 120-minute chart broke above the previous left side resistance at 99.35, and it made a high today, excuse me, of 99.50, and is holding above 99.30. Now it's right at 99.39 right now. It's going to be a very interesting thing, because you know the pattern we spoke about. I was talking about it last week before the market took a tumble, that there was a pattern, the Chapman wave drop bucket formation. Oh, I forgot. I haven't looked at the CD for a while. We'll talk about that in a little while. If I can remember in one of the breaks, I'll try to get to it, and I'll put it on so you can see what I'm talking about. That's that pattern right there. Holding above it for a couple of bars means that that's good action. Let's continue. So we're looking at the dollar acting quite well, but it's in leg D, but a very strong leg D. Look at the euro. It's got exactly the opposite. It's broken key support in the daily, but now the weekly chart is starting to challenge the left side. It's broken the support of the 24th of July at 1.080. Now it's down at 1.697. And if it keeps going like this, it's going to test the April low of 1.0520. The resistance now is at 1.085. Okay, let's continue, because I want to show you something very important. Bonds. Bonds are up 40 cents right now at 118.73. Well, how is this going to fit together? If I'm looking at the chart, if I'm looking at the yield chart that I showed you yesterday right here, this yield chart with a black background, the weekly chart, showing you a potential cup formation right on that long-term horizontal line that I drew in, just to show how many times the yields have been in this area. You can go back to 2011, but if I move this back even further, you can see you can go all the way back to December of 2008. We've been in and out of this area, up and down, up to the 48 level in the 30-year yield, down to the 22 area, 21. Let's see what the most important low was. That was that low right there. So 24.52, and then the last one was, 22.26. I thought I remember that. So this is going to be a very important moment. Why? Because if the market is going to take a breather, at this point, I'm still only calling it a breather, even though there's some sectors that are extremely overbought, then what we're looking at is that if the market comes down, money should flow back into bonds for the safety of bonds. That's just traditional. If that doesn't work out, then wait a minute. All of a sudden, you've got the makings of a market of bonds going. Let me put it this way: you've got the makings of bonds going down, yields going up, and that would imply normally that the market should be pulling back. So if the market actually rallies, that's going to be something very different. And that's another reason why over the last week we've been becoming more negative in my opening call. We've been taking on positions in volatility indexes and the market itself. And I just feel very strongly that this is a time out for now, the consolidation period in the market. And we're going to be focusing a lot on what the yields do. Because why? If yields, the 30-year yield especially, I want to show you a divergence that's occurring right now. If the 30-year yield goes to 32.56, closes above 32.56 on a weekly basis, that suggests I've got to probably start a new count. It could be an F. We've seen that before. It went to EFG, and that could happen here as well. But I've got to consider the fact that there might be a new buy mode in the weekly chart of the 30-year, the 10-year, and below is the 5-year, which is only in leg A. And not only is it in leg A, it took out the June high of 18.09. This week, it's already gone to, oh, it hasn't taken out 17.7. Oh, we're looking at the wrong thing. 1779 is the high. Okay, good. It hasn't taken it out yet. 1809 is the high of June. We're going to be watching that closely. All right. So I just wanted to show you the yields. Something's happening in yields that hasn't quite existed in this form before, where you got the 5-year. Usually the 5-year is the weakest. Right now, 5-year is the strongest. And that's going to be very important. We've got to make a note of that. Now, here's something else that I want to look at. Right there. I just wanted to have a quick look. Look, when you're going to crude oil, holding okay, but the weekly chart is just in a trading range. No big deal. Just stuck between, it's at 44.31 right now. It's kind of stuck between the 42-ish area. What was the low? Yeah, 42.50, so call it 42 area, and the 46s. So we'll see whether it's going to break out upside or downside. My eye says there's a good chance that is going to retest the low that was made at 42.58 the week of October the 30th, but that we'll see what happens. The week has just begun, really. I want to look at going back to the high-grade copper with all three charts. Look, that left side low that was made the week of the 2nd of October at 2.225, taken out. So the most important low is the low of August, the week of the 28th. At 2.196. We're at 2.213 with a high velocity to the downside. Finally, you're getting the stochastic and the MACD saying, hey, there could be a little bit of a bounce at some point soon, so be careful. If I'm looking at natural gas, NG, natural gas has made a low here. This is an a trough E low, and has made a peak E in the daily. And he's attempting with the technicals improving a little bit to get a bounce that says, if I can take, it's natural gas talking continuous, 2.349. If I can take out 2398 in the next 2 days, that'll start leg B up, but it'll suggest very strongly that the 9-period moving average for the very first time is going to have an opportunity to be tested at 2.599 for the last 3-4 weeks. It's a month almost. And now, what a month. It's stuck above. Back the week of the 18th of September, couldn't hold it. Held it just a brief moment in the week of August the 14th. But that black 9-period exponential moving average at 2.599 is formidable. It's now formidable resistance. So we'll see if it's able to bounce. If I look at the CCR, TRC, CI. This is the Reuters equal weighted. I don't know what happened here. It's just messed up the chart. The equal weighted commodity index trading at 338.20 up $1.29. Oh, I wish they wouldn't do this. I wonder how I can get rid of that. I thought if I went like this, I clicked on it like that, format. No, it isn't formatting. All right, and I thought if I went like this, Control R, they'd get rid of the bad tick. No, it's just a bad tick and I can't get rid of it. Actually, I could go there and change it by hand, but I'm not going to do that. A, B, C, D, E. It made a perfect peak E, and then it came tumbling down. And that peak E in the Chapman wave was right there on 409.48 back on the 14th of October. Plummets down to the low yesterday of 386.79. Big move. Trying its best to make some kind of a stabilization, but it's really hard. And the monthly chart is just suggesting so strongly that the 411 area, 9-period exponential moving average, is going to take a little bit more time before it can be hit. Yeah, this is commodities. We're in a deflationary period. That's why I'm thinking the deflationary period has to be hitting bonds. I don't care what the Fed is saying here. There's competition around the world. Why should our bonds be at 152 and 7/30 seconds, although it could be making the H pattern in the monthly chart? But if there's competition for yields, the lowest yields, competition to see who can give the lowest yield, then I don't see how the Fed can independently do it. That means it might affect other countries as well, where they're going to be forced to raise rates. I'm not sure about this. This is going to be a real tough decision the Fed has to make. And you look when you look at the housing index, it's kind of stuck. It hasn't been doing very well, but it's not doing badly. It's just not doing as well as it was before. I really do think that the Fed is kind of stuck here. So a couple of things that I wanted to do. I wanted to look at the volatility index, if you don't mind, VIX.X. That had a very nice rally yesterday to 17.09. The high today is 16.96. And the market is keeps coming down, and then it has a little bit of a rally. It's as if buyers are saying, you know what, there are a couple of bargains out there. We're going to do it light. We're going to do just little spurts of buying. We don't want to be aggressive buyers right now. That's kind of my thinking right now. And as a result, the 16.98 200-period exponential moving average in the daily of the VIX is going to be really important. I want to finish a couple of notations during the break. And I'll see if I can find my CD so I can show you a couple of chart patterns. I'll be right back.
If you're looking for a great opportunity to diversify your financial portfolio and hedge against the falling stock market, consider the new market-safe Metals Hedge CD from Everbank. This 5-year indexed U.S. dollar-denominated CD gives you exposure to metals with gold and silver components and allows you to hedge against falling equities with a short component on the SPY ETF. You can earn up to 45% capped upside payment at maturity if gold and silver increase in value and the SPY ETF decreases across annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on the CD. Don't let fallen markets get you down. Get the Metals Hedge CD. The November 12th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once again, that's everbank.com/TFNN. This is sponsored content. Everbank is a member FDIC.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Everyone, Basil Chapman, Tiger Technicians. We're back. Dow's down 36, S&P's down 4. There's some buying coming in here. It's not like we got this huge triple-digit follow-through from yesterday. Remember, in a bear phase, the ideal conditions would have you looking at bad news being taken badly by the market, actually all news being taken badly by the market, with selling periodically throughout the day, but then the last hour selling, like yesterday, I had a little bit of a bounce. It would be the reverse, because then you go down towards the low of the day, and the S&P futures would open down 10 or 15 the next day. That's intense selling, and the volatility index screams up into the high teens, low 20s. And bonds normally would be, because the market is coming down, bonds would be rallying and the yields would be coming down. All right. So there's a little mixed market here. We've got Apple down, was down sharply down, and now it's down 253 at 118.03. No big deal, but it is down, and it is impacting the semiconductor index because the SOX, the SMHs, let me find it over here. SMH is down 91. It was down more. Now it's down 53.84. So when I'm looking at this, so the charts you're looking at right now during the break, I was asked about EQ1, equity 1. It is the daily has gone to a peak E in the Chapman Wave daily. I've got it as an edit wave 5. Normally you can get a 1/3 retracement here, but I don't have anything like that. What I'm really looking at is the low of of the 14th of October is going to be absolutely critical at 25.24, because if it takes that out, EQY trading at 25.93, up 30 cents today, inside bar so far from yesterday's big candle, red candle. If it gets taken out, it would suggest that the weekly chart also is starting to fail, and the entire 25s becomes absolutely critical importance because the 25.02 level is the 200 period moving average daily support, and you've got this one right here, the 50. I just want to double check. I want to say it's some 32 period moving average in the weekly chart right there is at 25.15. So you've got a lot of support levels that need to hold. So far, it's holding well. If you're getting ready for a trade and it's doing well, and you got it at almost the low of the day today or yesterday, then I'd say fine. It should rally. It should try for 26.32, the 9-period moving average, to maybe make an arch formation. My suspicion is it needs more time after the big move it's had to the upside. EQY we're looking at. Okay. Go back to our story. And what I was looking at is, I just want to cover a bunch of things now before I run out of time. And then I say, oh, I had it written down and I forgot to look. IYT. That is the iShares Dow Jones Transportation Average. Remember, we looked at it yesterday, and I said, oh, it is making a leg D to the upside right now in the daily. Well, it's a huge candle, and basically what I like to do when I see a candle like this, I call them long-legged dojis. It's hard to imagine that there's any issue that comes out, opens the day, this is yesterday the 9th, and it opens at 148.07. Intraday, it has a low of 144.93 and a high of 151.02, and then it closes at 147.88. Right there, a little tiny candle. So what I look at, I immediately draw a rectangle, a rather large rectangle to the outer edges, but it doesn't take more than one session, maybe one, it could be two, but no, really, by one session, you have a lot of evidence, and that evidence says, this is my interpretation. It's got nothing to do with Steve Nissen's work on great book on candlestick charting. I do things very differently. I look at the candle and I suggest to you that when you see a tiny little body of a candle with long, long legs, like a daddy long legs, you know, they look awesome. They look quite fierce, and then all of a sudden you see them and they're really kind of they do nothing. They just kind of walk along, scare everybody. And that's the same thing here. It's just walking along, scaring everybody. On the upside, the bulls think it worked, and then it pulls back. The bears think, oh, great, and then all of a sudden comes right back and closes where it started today. It's the following candle or candles that are very important. And to me, this candle today of down 0.86%, 146.61 down, $1.27 in the IYT, the iShares. I'm looking at this and saying, hey, the technicals were very weak. If it was to the upside, I'd be scratching my head and say, wow, I don't know how it's managing to do that, turning the 200 period at 148.74 into support. No, it can't. It's not even holding the 9-period moving average of 147.16 right there, see? So this says to me there is weakness, and that the shakeout yesterday must have been one, maybe two stocks in the transportation average yesterday. Oh, there it is. Thank you. Yo in the den. Transports were boosted by news yesterday, and before that they were selling off. Canadian Pacific said to wait deal for Norfolk Southern. NSC, I believe. Let me quickly look at NSC. NSC. Oh, look at that candle. Okay, now I can understand what happened yesterday. I'll be right back. A break coming up. Yep, this is a break. The Dow's down 52, S&P's down 6. I'll be right back. Basil Chapman, Tiger Technicians out. Hey, give me a call, 877-927-6848.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks, we're back, and I just quickly get a notation of Norfolk Southern, not Norfolk with a K right there. Southern. Okay, this is very interesting. It had a spectacular move to the upside. You know, I got a question I'm going to answer. A really great question by Confetti in the Den. We've got 117.64 as the high. I believe it was an all-time high that was made. Yeah, all-time high that was made in November of last year in Norfolk Southern. It pulls back very sharply. It goes from the 117s down to 72.10. I would consider that to be a pretty serious decline. 40 points, almost a third. So what happens is there's a rebound. This is a rebound, and then there's the news yesterday. So if it wasn't for the news, Norfolk Southern would probably be in the 80 area instead of being in 87, having hit yesterday's high of 90.96. Now, this is going to be very interesting because it did help the transportation with that crazy candle. But if I'm looking at the transports, they're impacted by coal. They're impacted by a lot of the commodity area, as well as, of course, general business. Now, what's going to be very important for me, let me go back to the IYT. What's going to be very important for me is to see how the lower part of this rectangle is going to come out. Normally, I would do this, and I would immediately grab an inside bar and say, the 200-period moving average right there And just below it is really the area I'm going to look at for at least this week into next week. And there you can see it. And that essentially says that the 148, let's call it 149 area is extreme resistance. And on the support side, you've got 146, maybe 145. All right, a few points lower. Now, what's going to be very important about it is that the weekly chart looks like the technicals were actually very good. But the price never really, it snuck yesterday because of the news. It snuck to a leg B. That really wasn't an official leg B. Actually, I can even call it, I'll give it the benefit of the doubt. I'm going to call it an A, B, and that was a C. Because you see it restarted. Let me explain to you what I'm talking about in the Chapman wave. You had the spike from 128 to 26, the 200-period exponential moving average support plus trendline support, and it goes all the way down on the 24th of August and then rebounds strongly. It's very positive that it had candles that closed above this candle, especially the green candle. And what's important is that it went very quickly to 149. Well, you tell me, 20 points, that's 20 points from 12. So that's, what are we looking at, about 17%? That is a huge move. And in this particular issue, you're looking at a lower peak over there, gray A, gray B, and still a gray A because it's underneath that other very strong resistance right there, back on the 7th, week of the 7th of August at 153. So I'm looking at this and I'm suggesting to you that I drawn in the candle of, drawn in the pattern of an arch formation. There is a chance that this arch formation could continue. So a sideways consolidation in the IYT is most likely. And that sideways consolidation is going to suggest to me that if it breaks it's at 147. If it breaks the 146 support, it's going to sidle down slowly, maybe not so slowly, but it'll sidle down towards the 140, the 143 and 142 area. That's where the weight of evidence is going to come in for the transports. Can it hold that and then take this as a time-consuming digestive phase after the very sharp move up, and then form a breakout that takes you to 155. I need the evidence, and the evidence at this particular point says probably down before you can think of the rally. That's the way I'm looking at it. Now go back to the question that was asked by Confetti. I didn't read it. It says, Basil, with Dennis other than yourself, namely Andy Hecht, talking about the commodities crash in general and how it will affect the markets for the worse, what do you think could be the 10-ton pipe? That I'm pleased you used the word pipe because we're going to 10-ton because we're going to iron, that finally breaks the camel's back. I know it has me perplexed, and I know I'm not alone. Okay, so that's a question in the den, and it's a great question. Now let me just go through a couple of things here. When you're looking at the grains, look at corn. Look at the very long-term chart of corn. It's breaking down. Oh, how many times? Oh, there it is, the notation. Peak C minus. Corn just cannot get out of its own way. It keeps, in the monthly chart, keeps making this arch formation, small or big, it doesn't matter, but it keeps retesting left side lows and then takes them out. And I don't see any strength whatsoever in the monthly chart. If I'm looking at wheat, W, underneath the 9-period moving average, not quite as, it hasn't had the forceful moves to the upside as corn, but it also hasn't really broken down. It's just been sidling to the right side, making slightly higher highs, making slightly lower highs, and then much lower highs, and slightly lower lows, but gently making lower lows. That's really what we're looking at. If you're looking at lumber, I wonder if I can get that LB. Do I still get lumber? What happened to that chart? It used to be lumber. I thought lumber was, I know what we'll do. We'll go right here. If I'm looking at wood, which is the iShares Global Timber and Forestry ETF, a nice big spike to the upside, but it's come down from 56.69 iShares Global Timber and Forestry ETF to 44. I mean, that's 12 points. That's a lot. There again, you got yourself 18, what, about 18%. And then it goes to a peak B, and now it's going sideways. And I would suggest to you, I'm going to draw this in, that there's a chance that we get some kind of another H pattern. How low it goes is the big question. So when I'm looking at the commodities in general, now I'm going to go back to the charts. I'm looking at crude oil, CL. Look at this, ugly, ugly chart. Trying to find some support, monthly I'm talking about, right? Monthly chart. And now I'm going to say, what about feeder cattle? Well, feeder cattle has had a huge plummet. it had a spectacular move going in the continuous contract from about the low of May of 2013. I've got 127 up to the high that was made in October 2014 at 221. I am 221. 127 to 221. That is a whopper of a move, 80% or more. And now what we're looking at is it's plummeting. And whoops, I didn't mean to do that. And in the chart itself, you went peak A, B. Let me just double check this. A, B, C, D, E, F. I guess, no, you can't. This is an A, B, C, C minus. Very unusual for monthly charts to actually turn down like that. Can I pull this back? Oops, here it goes. Yes. Okay. And the monthly chart is about to test in the H pattern, the left side low. It's going to be really important. Why? Because in the general market, we've seen that this H pattern has turned into something very positive if it can hold and then break to the upside. It becomes that H pattern, lowercase h, that becomes a springboard for a move to the upside. So far, it's to the downside, and we're just going to have to wait to see what 161.45 is tested like. It's a point and a half away, point and a quarter away, down at $1.75 in feeder cattle. So let me go back to this. Now I'm going to try to answer your question. It's a great question, and it really is a question for someone like Andy Hecht. Folks, if you listen to the Commodity Hour Tuesday and Thursday with Andy Hecht at 5 o'clock Eastern Time, I mean, he's just a font of knowledge and practical experience in this whole area of the commodities. Just wonderful to listen. And he's written fantastic papers. Now let me just go here, and I wanted to do this. Why have we got a dollar sign instead of an at sign? At, what am I looking for? Because I lost my train of thought there. At HG. Oh, HG copper. I didn't do the copper. See, copper's breaking down. It is about to, I did. Copper's about to test that left side low of the 28th of August. That's going to be really important. Look at the monthly chart. Oh, my God. Look at the monthly chart. It's broken key uptrend support. This month is not even close to being finished, not even halfway yet. So that's just a question. So now, if we're looking at this, you're looking at the MACD and stochastic in the area where it should start to rally. But it also could just flatten out at 10% in the stochastic. It could just go sideways now, go to the single digits. And the MACD is negative, the histogram is negative. So, okay, Confetti had a question. I'm not sure. Oh, NS. Oh, it's a separate question. Yeah. No, I'm going to your question. At least this is still your question. So here we are. The question to the nitty gritty is, what will finally break the camel's back? And that would be the camel's back to the downside in commodities, or would it be the reversal to the upside? So I'll do them both. If you're looking at gold, and I think we have to put gold here, factor gold in as a very important component, because 1080 is the left side low, and today's low is already 1084. We are so close to breaking this in this arch formation. I'm going to tell you chart-wise. I'm not going to tell you specifically what I'd be looking for in different areas. I'm just going to try to deal with gold. I'm going to try to deal with the dollar, because I think that the Fed is really more worried about the dollar. This is my thinking here, than just the interest rates, because interest rates can move higher without the Fed just even mentioning. They don't have to do anything, but the dollar, they don't seem to have any control. They lost the control over the dollar once it started to break out from last year, summer of last year, and then started to move so quick. Look, we've gone from May of 2014 to October, November, to November. So 1.5 years, you've gone from 70, let's call it 70, the 78s, to the high that was made less than a year later at 100. That's a 30% incline, 30% gain, and a very sharp incline. And it's taken a cup formation of almost a year, 1, 2, 3, 4, 5, 6, 7, 8, 8 months. And we're on our way to attempting at least to retest that previous high. So Confetti, I'm going to say to you, I would prefer, rather than look at individual commodities which have their own characteristics, I'd prefer to say that in the overall scheme of things, you will have to see the dollar not just come down, Dollar at 99 would have to actually pierce 94, 93 to 94, absolutely imperative key support level. If it takes that out, my thinking is on the way down, you will already start to see, I'll name them, you'll start to see GC, you'll start to see gold move from the 1090s really quickly back to the 1130, 1140 area very quickly. If you see that, you should see crude oil start to move instead of breaking down. Well, if the dollar breaks out above 100, you will see these commodities go even deeper. And the bias right now is to suggest to you that the framework that we're looking at, it's like a Rubik's Cube. Oh, I saw someone recently do a Rubik's Cube. They timed it. It was 12 seconds, I think, 12 seconds. And then he did it with one hand in 15 seconds. Anyway, so let's go back to our story. So this H pattern in the crude oil, it would break immediately from the 40s. It would go to the 51, 52, 53, 55, 56 area, just like that. And it would then break the 9-period moving average in the monthly chart. So I do believe that you're looking at the weight of evidence is suggesting, and that's what I'm also suggesting, that because the dollar has moved higher, I wonder if I can do this. Let me just see if I can do this right now. I'm going to just find it here. I should have a chart that I can use as a demonstration. UNP Weekly, let's go to that one. Let's just, oh, there it is. Okay. So UNP Weekly. So here I've got the SPY, and I've got UNP United, obviously United, it's Union Pacific. Now, I've mentioned this before. I was told a long time ago, Union Pacific, if I follow Union Pacific, I'll be able to follow the SPY. And I tested it out, and then I finally figured, you know what? It's kind of right, but it can sometimes be kind of wrong. And there it is. The weight of evidence is that the S&P actually went on, the red moving average there went on to higher highs while the Union Pacific was crashing. But there is a relationship that I don't want to deny. So I'm going to just take that away for a moment because I want to get to the, how am I going to do this? Can I do that on this chart here? Let me just think it through for a second before I do anything here. I'm going to go back. Let me go back here. The relationship I will have is, I'll do that. Okay, here we go. I usually don't like to mess with these charts, but here we go. I'm going to change this, and you're going to see something very interesting. I'm formatting it to the UUP, which is the trading vehicle. It's called the PowerShares DB US Dollar Bull. Have a look at this chart, and you'll see that, yes, in a kind of a way, this is the Union Pacific. This is the chart we're looking at. And just because we're looking at a different chart, I'm going to make it a different color so we don't get confused. Style, open, high, low, close. Let's just make it cyan. We're on our way. Here we go. Okay. So that is the dollar, right? Making a cup formation. Now, this cup formation, you'll see that there's a much better template if you use the gain in the dollar, most recent gain. You can't take it, you've got to take it from July of 2014. There's more a similarity with the strength in the dollar with the S&P than there has been to the Union Pacific. Okay, I just wanted to show you something. That I would prefer to think that the strength of the dollar could in fact help and not hurt the general market. Now that's a little controversial, and I can't just say that and get away with it. I'm gonna have to explain it. I'll be back.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, folks. Just quickly while we're at it here, I had a bunch of questions. I'd like to do that. So DH Horton, I don't know if they've given earnings estimates yet, but it's up $1.81 and 30.85 and 30.56. So this is what I'm looking at. A monthly chart, a leg, a peak E, but it's very strong. It's one of the stronger housing sector builders that we're looking at. Weekly chart did make a peak E, but a nice rebound from the high of 30 in the 33s, 33.06, down to this trough B, leg B, I should say, low to yesterday at 28.45. So it's holding very well. Whether or not the earnings have come out, I'm not sure, but it's doing quite nicely. And it's one of the better ones. If you are long, I would just say let the earnings come out. Let's find out what happens. But if it holds the 29s, in fact, if it holds the 29.50 area and even goes a little higher, this is going to be a very good stock, and it's going to be a tell on some of the area. Paul wants to know about IBM. You know, IBM is just terrible. I think IBM is going to, it's a 134. 127 has been my target for the 200-period monthly exponential moving average. That's been my target. I don't know why I just didn't. I spoke about IBM making a flat base restart top at 215.19, and it should be a serious hat-trick top, and I never went short. Sorry about that. But anyway, that's what I'm looking at. Question is, Julie asked about the 2. Julie, I saw it recently. I'll do a little work on the 2-year and talk about it tomorrow, about the 2-year. Next question is Paul. DB, Deutsche Bank. I think that this Volkswagen thing is just a joke. Give $1,000 to people who bought a particular vehicle with a sole intent of doing something, and then it doesn't do it. I think they have a serious problem, and Deutsche Bank might be the bank that is really that's where the U.S. government just keeps hitting, because they probably the bank for the VW. I don't know what it is, but it looks terrible. The chart, Deutsche Bank, looks like it is going to go much lower. In fact, I wouldn't be surprised if it gets another 15 to 20% hit unless something spectacular happens. Volkswagen's going to have to do something amazing to get out of this. And this is a big issue. And yeah, I agree, Go in the Den. DB, it might be something telling us about Europe. It's a special case, but that's what it might be telling us. There was one other question that was Adam, Paul, Julie, Samantha. Here's another question. The question is, about the IYR, which I had spoken about yesterday. Yeah, IYR is having a little bit of a bounce today, and that's going to be important because you see the TLT is bouncing, it's up 54 cents. So that's saying to me, this is a bounce. At this point, only thing I can call it is a bounce. At 73.62, if it gets between 74.30 and 74.70, I'm going to do an analysis, or anywhere close to the 74 area, I'm going to do an analysis to say, is this now a short? Will it come down in an H pattern? So I just wanted to go through those things. I'll cover some of the stuff that we were talking about today, tomorrow, and for subscribers. We've got our positions. I didn't want to add too much more. We've got our shorts, we've still got our longs. And I'm impressed with GE. I have to tell you, I'm impressed with GE at 30.27, 30.08 today, having hit 30.27 intraday, leg C in the weekly, breakout in the monthly. I've got a G, but let me tell you, a lot of this looks like it could be. This is going to have to put together this coming weekend in a really big synopsis. And I think it's getting time now to talk about, have another webinar. I'll have to try to plan it and see if I can get it organized. Talking about the Elliott wave, is this leg 5 and what can happen? Where could pullbacks go to? And what do you want to do? What would you like to own if there's going to be another move to the upside now? Do you want to go back into the biotechs? The IBB is still looking terrible, having gone from 400 down to 284. And a little bit of a rebound. Peak E, it's sort of stalling. So we'll talk about that. Tomorrow I'll go through some of these. And if you do have questions, try to get to me earlier in the show tomorrow, just if you want to type them in, because I don't want to leave them for this last few minutes. This last few minutes is really where I want you to be discussing the day and what would happen to the VIX, etc., what we've got to be looking for. So I'll be back tomorrow. Have a great
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN,